Now that we know what financial institutions are in general and what they do in particular as far as jargony tasks are concerned, let's take a closer look at the type of financial institution that we're going to be looking at for the rest of the class, and that is, of course, the bank. Recall that a bank is a depository financial institution, so it's a financial institution that takes money but gives it back the instant it's desired. So it's essentially a storage place for money. So that's the first thing. They receive depositors' money. The first thing in the definition here. They really can't function if they don't receive depositor money. But of course, they also have to give it back at some point. Um, so how do they operate then? If they receive deposits, but they have to give it back with interest at some point, how do they even make money? Well, that's that second part here. They make loans to borrowers using depositors' money. Banks essentially know that when people park their money at the bank, they're going to leave it there for a relatively long period of time. Sometimes just for a matter of days, like with checking accounts, sometimes for years, like with a certificate of deposit. As banks get accustomed to knowing how long a given dollar is going to spend in a given account for a certain period of time, especially when they set the rates of interest up that they're going to pay the depositors for leaving their money in the bank, banks get a good sense of how much time they have to lend out a given dollar before they're going to have to give it back. And they use that to figure out just how much of it they're going to lend out and how much they're going to keep. So, from the standpoint of what financial intermediaries do in a money market, where remember we have the supply side in a money market, those are people who have excess money that they're looking to put to work for them essentially. They're looking to rent it out to people. And a demand side, people who need loans, and banks bring them together. So that's that third part down here. They move savers money to borrowers. So savers money, those are the people on the supply side of a money market. Their money goes into the bank. They are the savers. And then the bank is responsible for moving that money to the demand side of the market and helping to set the price that is going to be charged for it, that the demand side is going to see, and then the savers are going to get some of that price. So the savers are you when you deposit your money in the bank, you're kind of working with the bank on the supply side, and you're splitting that price that's being charged in the market, where of course the bank gets to keep most of it, but if you have an account like a savings account where you're going to keep your money there longer, the longer it stays there, and the more of a commitment you make, like with a certificate of deposit, a time deposit, which we discussed on the video about the different types of money, the more of that interest the more of the interest you're going to get to keep. But the banks still keep most of it. Of course, they do the work, and especially nowadays with federal deposit insurance, which we'll cover a little later, they're the ones who are taking the majority of the risk. So it's generally seen as legitimate that they keep most of the interest that they're getting from your money. Because again, you don't put money into a bank usually in order to earn interest. You put it there to have a safe place to keep it until you need it. Which is why if you study how wealthier people where they put their money, you find that actually a very small percentage of it ends up in a bank and most of it ends up somewhere else earning a better rate of interest like a mutual fund, something with a lot of stocks, etc. So this is in general what banks do. And now there's something called fractional reserve banking, which you may have heard that expression, especially in the wake of the financial crisis in 2008. Some economists like Larry Kotlikoff, who's prominent for his work in estimating how long Social Security is going to be able to run for without any changes, he's described the banking system as fundamentally unsafe because it lends long and borrows short, which is a fancy way of saying that uh, it has depositor money for a very short period of time, but it makes loans that it takes a long time for these loans to get paid back. So there's a certain inherent vulnerability in the banking system. Now, other economists think that Kotlikoff and economists like him who say use terms like fundamentally unsafe are being a little melodramatic about it, but there is still a a certain tentativeness to the banking system, a certain level of vulnerability there that requires great care on the part of banks to make sure that they're always able to give depositors their money back when they want, but they're still able to make long-term loans that really drive the profitability of banks. And the fractional reserve banking system is essentially how this happens. So this definition here, break this down, a banking system in which banks have to keep only a fraction of deposits on hand and available for withdrawal. What that means is if, say, a bank has 100 people who deposit $100 each, that's $10,000 that people have parked in the bank, and they've parked it there only for a short period of time. They're going to want their money back eventually. But they're also, a lot of them are going to expect a little bit of interest. What the fractional reserve banking model says is that we figure that of that $10,000 that was put into our bank, on any given day, we're not going to have people coming and looking for more than, say, $1,000. So we have $10,000 in cash, but we only need $1,000 on any given day in cash at the ready for people to take out. And as people take it out, other people are going to be putting more money in. So $9,000 of that $10,000 we're gonna just loan out to people, and they figure out that they only need 1,000 just from experience. They know how long in general people want to keep their money in the bank. Because over time they get a sense of what behavior is like for their depositors in different account types, so they're able to get a pretty good sense of how much money they need on any given day to be able to satisfy all requests for withdrawals. So $9,000 is out there in the form of loans given to whoever needs to borrow money for whatever reason, and that's earning interest, so that $9,000 is going to become quite a bit more than $9,000 over time. And at all times, banks have $1,000 ready for people to withdraw, knowing that other people are going to make additional deposits, so it's okay to have that $9,000 worth of loans out there. So it's called the fractional reserve banking system because in reserve at any given time, that $1,000 is just a fraction of the amount of money that has actually been deposited into the banks. So with this first way of looking at things, you can kind of get a sense of where people like Kotlikoff are coming from when saying that this is a pretty unstable way of doing things. But as we get to know banks a little bit better, we'll see why bank collapses are actually exceptional events historically rather than the norm, but they certainly have happened. So the reserve requirement is essentially, this is a law that in our country, the Federal Reserve, generally around the world, any central bank will tell banks how much money they have to have on reserve. Now, banks will oftentimes have this amount on reserve anyway, just because of their own experiences telling them how much is going to be needed at any given time. For banks' own interest, they themselves don't want to be in the position of having a depositor come up and say, hey, I need to make a withdrawal, and then having the bank say, sorry, we don't have the cash on hand today. It's not a very good way to run your business, not a good way to get people to continue to deposit money in your bank. So they want to make sure that they have sufficient funds anyway. Nevertheless, some banks may be a little too willing to take too many risks with too much money and get into that situation where there might be runs. So just as an added layer of protection for the economy against this sort of shutdown of banks and against having runs on banks, it's pretty standard practice for the Federal Reserve System to have reserve requirements to say that if it's a 10% reserve requirement, for example, then our sample bank that had $10,000 in deposits overall, by law, can only loan out $9,000 of those $10,000. It has to have $1,000 on hand at all times, ready to give to whichever their customers come along asking for their money by law. They're violating the law if they only have $900 or $500 or whatever. They need the full 1,000 by law at all times. While the other 9,000, they can go right ahead and lend out. So even though I seem to be downplaying the importance of this, which I don't mean to do necessarily, this is something that's going to come up multiple times. It's going to come up when we have to calculate the money multiplier and see how the money supply is expanded kind of naturally by the banking system, and also when we look at the levers of monetary policy that the Federal Reserve has. So keep the reserve requirement in mind. We're going to be revisiting it often in the next few videos and throughout the rest of the semester. And we'll usually abbreviate it as RR, like railroad, but this R and this R is reserve requirement. Reserves are just the amount that banks have on cash at any given time. The requirement part is the legal part, the part where we're saying that the Federal Reserve won't let the bank have any less than this on hand at any given time in order to be compliant with the law. So this equation here is kind of a useful identity because you're going to be asked questions that are going to have you try to figure out certain things using algebra. So you're given the reserve requirement here is a percentage. I know it looks like the same thing, required reserves and reserve requirement. The difference here is this is a percent. So this is being multiplied in here, so it's going to be in the form of a decimal, a 0.1 or 0.05 or something like that. This is an actual dollar amount. So in the example of $10,000 worth of deposits, if you need 0.1 of that, or 10%, to be in reserve at all times, then the dollar amount for required reserves is going to be $1,000. And you can get that $1,000 if you don't know what this number is, but you have this percent, and you know that $10,000 has been deposited in the bank. This $10,000 multiplied by 0.1 is going to give you your required reserve amount. So 10% of the deposits are going to be your required reserve. So it's a useful identity to keep in mind. So as an example, to give other numbers to this, a bank's required reserves, what do they need to have in reserve if the reserve requirement is 20%, which would be 0.2, and the bank has a total of $20,000 worth of deposits. Using this formula, we plug $20,000 in there for deposits and 0.2 in for the reserve requirement. And then when we solve the math, we get that the required reserve amount that they need to have at all times is $4,000. So nice and easy. But some questions may be a little trickier where they'll put that $4,000 in here and the 0.2 here and ask you, if you know that this is what they have in reserve and they're loaned up, is the terminology for saying they have loaned out every penny that they legally can and they have only what is legally required in reserve. With this reserve requirement, how much do they have in actual deposits? And then you can use algebra to find that 20,000. And this is going to be something that we're going to do often with the bank balance sheet, which we'll get into in future videos.